When you're thinking of long-term wealth creation, sometimes timing your exit is as important as the very investment that you're making. But Firoz, for all those people who spend all their time thinking where to put their money, what are the parameters on which they should actually base the exits from these investments?
You're right, Sumera. Actually, exits are as important as purchases because what goes up also comes down. So you have to identify when to quit the game.
But they say that past performance is not a measure of future performance, right? So therefore, how do you actually know when the time for your investment is up, or rather when you should be redeeming it?
It is different for equity and debt. On the equity side, for example, if your goal is met, you're supposed to be removing your money, or even if you've come very close to your goal, you don't want too much equity. So exit is on account of goal being met, point one. In the interim, if there are a few changes, like a fund manager moving out. Second, the objective of the scheme changing. Third, very contrary to our belief, if the scheme has done phenomenally well, you need to be more vigilant with that scheme because there is a propensity that the basket of stocks the fund is owning has already done their share of contribution to the NAV.
So what about debt then, Firoz? Because that has been the area of pain for retail investors in the recent past. What happens if one of the securities held by that fund goes bad?
What happens is most often than not, when an underlying instrument in a debt fund goes bad, there is immense amount of panic because in debt you always got in because safety was paramount. In that case, don't panic, point one. Point two, evaluate the cost of an exit. For example, if a debt fund has a bond which has defaulted to the extent of 3%, measure it as against the cost of an exit, which would be the tax and the exit load. If the tax component and the exit load component is 2%, you're actually trying to save just 1%. So if I was the investor, I would definitely not exit because a debt fund actually has diversified the portfolio enough to make sure that any default does not break your back and creates credit risk to the extent of 20, 30, 40% of the portfolio.
So Firoz, when you see one of these red flags going off for one of your funds, do you stop the SIP or do you look at redemption?
In this case, an exit means stoppage of SIP only, not redeeming the existing invested amount. But it's very important to keep your eye on that fund where you've stopped an SIP because the installments which have already gone in deserve your attention. So you'll have to be very vigilant of the amount. But whenever there's an exit, it actually implies that you stop putting more money, good money, to the bad.
So Firoz, how does an investor actually action their exit?
If it's a lump sum investment, exits are very simple because you just have to send a redemption form or a switch form to exit a scheme or exit the asset management company completely. When it comes to a systematic investment plan, the turnaround time, the TAT, for it is longer because it will actually have to go through a couple of layers of expressing your desire to stop the SIP because the bank also needs to know that the electronic clearing service needs to be stopped. So there, it will take 7 to 8 business days to actually implement a stoppage of an SIP.
Firoz, a lot of mutual fund investors, at least the ones who are starting out, hear terms like alpha and beta and they don't know what to make of it. And to be honest, they sound quite Greek.
Unfortunately, in the world of finance and investing, the words and the nomenclature used is marginally more complex than the concept itself.